Alli, I'll start with you, whether it's the trade angst, whether it's the increase in coronavirus cases in a number of states and also hospitalizations, whether it's the data we've been getting out this morning and overnight. What is driving the market right now?
The market since basically quarantine has been driven by our fast and furious Fed, which has been followed by Federal Reserve support around the world that is both unprecedented in scope and extraordinarily targeted. There are also two other things which are driving the market and I think will continue to produce volatility, one of which was evidenced last night, which is continued conversations and tension and volatility around the election. China rhetoric is going to play a large part of that. Taxation will also play a large part of that. The other thing is simply the second wave. Now, obviously, we've seen both in this country and in Asia significant second waves, but that seems to not be affecting the market in the way in which a lot of us thought it would. And again, that just simply goes back to the Fed. When you look at the amount of stimulus, the amount of money, M1, money supply that's been put into this economy, in the last 3 months, our money supply year over year has grown 34%. There is a strong correlation between year over year growth in money supply and, not surprisingly, in multiples in valuation and in equity prices. And I think, this is really, again, fast and furious Fed is really tough to fight on a micro level.
Yeah, and certainly there's no denying what the Fed's policies have meant to this market. And along those lines, I want to get your thoughts on this topic, Leo, especially since the market is really, at least right now, pricing in a quick recovery to normalcy. The S&P has retraced, 75% of the losses in less than 3 months? How sustainable is that?
Well, as long as the pace of change continues to improve, then I think it's still sustainable. In other words, when we look at economic data, while it is not as good in any measure as it has been, it is improving consistently, and that pace of improvement is actually accelerating. More importantly, in the world of the science, we're seeing that improve dramatically. So when we look at whether it's vaccines or it's therapeutics, there's so much going into that solution all at one time, money, brain power, that is developing very, very quickly. And that gives hope that we're going to open up quicker and we're going to have a much faster recovery. Add to that the Fed, add to that the stimulus and all of the capital that's poured in the system. And it's not very surprising that we have a recovery. Now, in terms of valuations, obviously there are pockets of the market that have really shot up and are starting to reach extremes. There's some significant valuation gaps in the market between certain sectors and industries. And I think investors just have to be very smart and disciplined at this particular time. I think the biggest mistake an investor can make is trying to match the volume of news flow with the volume of activity in their portfolios. This is a point where you have to be smart. It's good to have a little cash on the sidelines, expect volatility, and be mindful of two things: your allocation, your targets, and what the valuation is in the market. Discipline is the call here, especially after a run this significant.